I do business development here for Home Probe. And so I was lucky enough to be able to host this video. So today we're going to be talking about jumbo loans. We are doing kind of a short series, and we're going to be talking about jumbo loans today. And then we have a luxury inspection class that we're going to be doing on the 28th. So keep an eye out for that. And so Dominick is someone that I work with a lot here in the Charleston area. He just is someone who I consider to be an expert in the industry. So with that, we're going to kind of just jump into that. We have some questions that we're just going to that we think are kind of hot questions for this topic. But then anything else that you have that you may want, that you're finding or have a question, please put it in the Q&A box. And then I will be monitoring that when Dominick gets through. So that we're going to keep this to 30 minutes. And so just anything that you have or any comment once we get going, please put it in the Q&A, and then we'll come back to that at the end of the class. So Dominick, welcome.
Hi there. How are you folks?
Thank you for having us.
Well,
so as we talked about, we're going to jumbo loan as a whole is going to be our topic, but you've kind of given me some more specific questions. So let's just jump in. And the first one that we talked about is just the basic, what is a jumbo loan for those that don't know? And then there was a phrase that you mentioned to me that after being in real estate for a lot of years, buying and selling in that high balance areas, I wasn't really familiar with that term. So I think that's kind of important just to, even if it doesn't pertain to us, to know what that means in case it's someone else brings it up. You kind of want to know what they're talking about. So I'm going to let you run with it. And then we'll kind of go down our list of questions and then also answer any questions anyone may have. So Dominick, take it away.
Hey there, folks. Thanks for joining, Wendy. Thank you for having me. Folks at Home Probe are awesome. I've personally witnessed their product and personally referred their product, personally used their product. And I don't think there's anything in the industry like the product that Home Probe puts out. So they're my go-to whenever anybody asks me. That's where I'm sending my folks. So jumbo financing. So what makes a jumbo loan jumbo is when the loan amount is above what's considered the conforming loan limit. What is that? The conforming loan limit right now is $647,200. So any loan amount, and again, we're not talking about purchase price, we're talking about the loan amount. Any loan amount that is $1 more than that $647,200 is considered a jumbo product, considered non-conforming. Conforming means that that loan is able to be sold to Fannie Mae and Freddie Mac after closing. What does that mean, Dominick? Well, 99.9% of lenders in my space, we are a direct lender. At the closing table, it is Family First Funding lending the money. After closing, like almost every other lender of our size and in our space, we sell the loan to the secondary market so that we can get that money back to go make another loan. So if a loan is conforming, meaning it's underneath that conforming loan limit and it meets certain other criteria, Fannie Mae and Freddie Mac are able to purchase that loan from us and then give us that money back so we can go make another loan. So Fannie and Freddie set limits every year, along with the Federal Housing and Finance Administration. They set the loan limit, and they do it based on trends. As a matter of fact, this time of year is when people start speculating how much it's going to go up. The rumor going around is like we're going to see a new conforming loan limit next year, beginning January 1st, of like $715,000. So we're going to go from 647 to 715. It's a significant bump. But there are areas of the country that have been designated as high balance or high cost areas, where inherently, because of the nature of where these counties are, almost every loan is non-conforming, which means that it would make it more difficult for investors to go in there, for lenders to go in there and lend in a way that would be available to just about everybody. So they designate certain areas of the country as high balance areas where your loan amount can be above that 647 number and still be considered a conforming loan able to be purchased by Fannie Mae and Freddie Mac. Whenever a loan is able to be purchased by Fannie and Freddie, you've got the best opportunity of getting a very marketable, a very market-friendly rate. Once you get outside the conforming loan limit box, rates start to flip around a little bit. So I'm going to show you, I'm going to just share a screen here and give you an idea of what areas of the country, and it's minimal, are considered high balance areas. So just give me 1 second here. So can everyone see the screen of the United States of America?
Yes.
Okay. Everything in gray is conforming. Everything not in gray. See some areas here in the Northeast, the New York tri-state area. This is the DC area here. You've got some areas along the West Coast, right? And then Alaska and Hawaii are considered high balance. So what that means is, for me, that means like 98% of the country is working with the conforming loan limit of 647. You know, again, with the exception of some of these areas in the New York area. I was surprised not to see anything in the Atlanta or Charlotte area. I was also surprised, actually, there's one little county down here that is high balance in Florida. And I just noticed that now. I want to say that's probably Key West area as you head out that way. I'm not sure, but those areas are considered high balance, which means that they can get a conforming loan above that 647 number. So it just the loan limit changes every year. We saw a significant increase from 2021 into 2022, and we're anticipating getting another large increase. Usually it's somewhere between, you know, either side of 3% in years gone past. But since this market run up over the last couple of years, I mean, last year was significant. It was, you know, 100K, which was a lot of money, and that they're anticipating doing that again this year.
So as far as qualifying for a jumbo loan, are there specifics like hard and fast?
Well, qualification for a jumbo loan is usually very similar to
what your lending needs are. I mean, it's number one.
I'm sorry?
What your lending needs are. I mean, it has to fit that criteria.
Right. Credit. We're going to look at credit. Higher scores mean lower rates, income, and assets, which means
It's the same as a conventional.
Same as a conventional. The thing that makes jumbo loans a little bit different, they're going to add in another layer, and we refer to those as reserves. Most jumbo lenders, most jumbo investors want to see a cushion. They want to see an amount of money set aside. It could be in your 401k, it could be in your retirement funds, it could be in some annuity or something like that. But they want to be able to see that in case of something going wrong, you've got X amount of months of reserves stored aside. Depending on the loan scenario, it could be as little as 3 months. It could be as many as 24 months in some cases. It all depends on the investor. It depends on the scenario, the credit scores. I will say this, most jumbo investors are looking for a lower debt to income. On a conventional loan, we can have a debt to income ratio up to 50%. Most jumbo investors that I've seen are not much higher than 43 or 45 DTI. Okay. So, you know, you're looking at a different income category. Remember, these jumbo investors who are lending this money directly, they are not selling that loan to the secondary market. They're actually going to keep it.
They're going to hold. Mm-hmm.
They're going to hang on to it. So they are going to make sure that the parameters of that loan profile suit their guidelines, what they think is a good loan. So you might see a little bit more stringent FICO scores. You might see a little bit more stringent DTI. Like I said, they're going to ask for reserves. They may want some other debts paid off prior to closing. So it's a little bit more, I don't want to say nitpicky, but just a little bit more trying to make themselves more compliant to what they believe is a good risk, because they're not selling that thing off. They're going to hang on to that jumbo loan because that's how they're going to make their money is on servicing the loan.
Right. Now, are there alternatives to If it doesn't fit to the conventional and the jumbo loan process is an issue, are there other options for someone or other types of loans? Or I know that a lot of the lenders are getting creative.
Yes, so there are a couple of different ways to attack a jumbo purchase. One of the strategies that we've used, and I'm in the middle of doing one more now, is the idea of doing a first loan of a conventional size. So let's say the property, I'm going to use, it's a $900,000 property, okay? And the borrower wants to put 10% down. So we're going to do a first loan of $647,200 and get them a great rate because it's a conforming loan, and we're not going to have mortgage insurance because we're going to get a middle loan or a second loan, or what I call a piggyback loan, which is in general a HELOC, to cover that other 10% in the middle. It's usually an interest-only loan. It's usually in the form of a home equity line of credit, which once the borrower pays off, if they're able to pay it off, they don't make that payment anymore. There's no there's no prepayment for that. And then the third component is the 10% that they're bringing down for down payment. So you have an 80% of the purchase price in the conforming, 10% in the HELOC, and then 10% is your down payment. It's called an 80-10-10 piggyback loan. There are products out there where we could also do that with 5% down. Again, a little bit more stringent, a little bit more reserves, a little higher FICO, but the first loan is 80% of the value of the property. The middle loan is 15%, that HELOC, and then the third piece is 5%. But those are going to need some significant reserves. But that's a way to get around jumbo financing if it makes more sense. You have to look at the first and the second together and see what those payments are, and then compare it to one jumbo loan and see what the payments are. You want to, my job is to give people options. Here's option A, here's option B. You got to make the best decision for yourself.
Well, and everybody's situation is different. And that's the thing that's kind of, I think, in the lending world, having been in this market, not this market, but just being in real estate for so many years, it's just how things have changed and just how creative companies have become, and just the prices. And it really has changed quite a bit. I know we're going to talk about rates and kind of what you've been hearing. We all see things on TV. We all, hear things, but I want you, as a person in the know, to give us some kind of insider info. But the other question I wanted to be sure to ask you before that is the investor market. I know that here in the Charleston area, and I'm sure in the Atlanta area, it's been a big deal. You have investment companies, you have investors coming in and buying bulks of properties, and that you had mentioned to me last week that you have been seeing changes or that, and I wanted you to kind of just elaborate a little bit on that, because I know that for our agents, that they want to know about that and what you're seeing. So please elaborate.
I've been trying to figure that piece out for a while. So we heard in 2020 and 2021 that there were these large investment companies, folks that you have your IRA with, your annuities with, your 401ks with, these asset management companies that normally don't get involved in real estate, buying up large tracts, large amounts of homes in a particular area, and turning them into rentals for themselves. They became, these big asset management companies became real estate investors for the first time in the history of history. And it was very disconcerting because we saw a lot of cash deals go through that way, because they would come in and just swoop in and buy things cash. And they would approach, I read stories where they approached developers and said, listen, we're going to buy this whole planned unit development, 80 homes, 150 homes. We're going to take the whole thing.
It's happened.
Get going, start building, so we can start renting. So that was an anomaly for a lot of people. Where is this coming from? And I asked a lot of financial advisor people, I said, what's going to trigger them to sell? And the idea was, the minute they can put that money someplace else and make more money with it is the minute that they're going to start offboarding all these properties. Now, from a supply and demand perspective, I think it would be foolish for them to just literally unload all that stuff at the same time. All you're going to do is drive values down. So, but we are hearing that they're starting to, little by little, offboard some of these assets that they bought, and take their money and go put it someplace else. Where that is, I'm not sure, but we are starting to see an exit out of that, is what I'm hearing. But this phenomena of asset management companies coming in is just brand new. And I think the low interest rates and the hot appreciation market, I mean, these are not stupid people. They're smart people. They're seeing 20% appreciation. Wherever you can make 20% on your money, you're going to go do it.
Most definitely.
And, now that is slowing down a little bit, I think we're starting to see them take their gains and go, which is going to mean a little bit more inventory, which is great because buyers have been looking for inventory.
Yep.
Unfortunately, rates are high. Interest rate, mortgage rates are a lot higher than they were a couple of years ago. So that's keeping some people out of it. But yeah, that's a phenomenon that no one had a playbook for. And now we'll find ourselves.
As have been so many things the last few years.
Yeah, I mean, we got playbooks now for a global pandemic.
Yeah, who would have thought? It wasn't in my plan. I'm sure it wasn't anyone else's, but the investor thing was just such a big deal. And I just kept hearing that from agents, just, investor groups coming in looking for this, that, and the other. So when you had mentioned that when we met last week, it was just like, oh, that's a great piece of information. So knowing that slowing up, and then that some of that inventory may be coming back into the market here in the near future I think is great news. So, and then I wanted you to talk about, we've got some time left. And like I said, anyone that has any questions, please feel free to put them into the Q&A, and then we will answer those at the end of this. But you want to talk about rates, what you're seeing, what we may be hearing, as opposed to what you're seeing behind the curtain. So little insider info on that.
Okay. So behind the curtain, right. So a little bit about where I've been. I, for 25 years, worked at a money market brokerage firm. And, the rate that we keep hearing about, the Fed is raising rates. The Fed is raising the federal funds rate. That's the rate that I traded. That's the product that I traded for 25 years. So I'm really kind of grew up being in tune with interest rates and how they move around. When I started, it was very clandestine. Everybody had to guess what the Fed's target was based on the actions they were taking on a day-to-day basis, whether they were adding money to the system or draining money to the system, was how we figured out that the Fed was, manipulating interest rates. Nowadays, they're very transparent. We almost know way before it happens how much they're going to tighten. But the federal funds rate has absolutely nothing to do with mortgage rates, absolutely no correlation, but it's all we're talking about when we talk about mortgage rates. The federal funds rate does impact prime, upon which almost every home equity line of credit is based on prime. A lot of car loans are based on prime. Credit cards are based on prime. Consumer facing products are based on prime. If the Fed funds rate goes up, prime rate's going to go up. So from what I've been hearing over the last week or so, we've got a couple of more meetings this year, one next week in September, and then one in November. And the speculation is this morning, that they're going to raise the Fed funds rate 1 point, which would be the most aggressive rate hike that they've done during this series, in terms of going 1 full point, and then maybe another 50 to 75 in November, which should bring the Fed funds rate to somewhere between 4% and 5%, which means that prime will probably settle down someplace between 6 and 6.5, which is going to really impact some of those folks who have HELOCs now. Because if you're prime plus 3.5, what you thought was a 4% rate when you started it a year or so ago, now that's going to be closer to 9. 6 plus 3, 6 on prime plus the 3% margin. So we've got, like, Fed came out and said, yeah, there's going to be some pain. So I'm getting a lot of phone calls on folks who want to refinance their HELOCs. A difficult thing to do right now, because there's not many opportunities to refinance that lower. We could refinance into a fixed, but those fixed rate HELOCs right now are probably right where, you know, the adjustables are right now. So I think that the idea here is to ride it out and see what happens next year. My thought is the quicker and higher we go up rate wise, meaning if we could be done with rate hikes by the end of the year, we're going to pause a little bit, see how things shake out first, maybe second quarter. And then the speculation is that rates should start to slowly ease off. We've been talking about recession.
And that was my question, because I've heard things, it's going to hurt at the moment, but then looking into next year, there's talk that things are going to come back down. Do you have any idea? Okay, down to what, you know, I mean,
there's the question for the agents, right?
Yeah, I mean, it's not going to be what we've seen.
It's really going to depend on inflation. I think normalized interest rates in an economy where inflation is not out of control, where unemployment is at a comfortable level, mortgage rates should be someplace between low to mid 4s to low to mid 5s. We should be someplace between 4.25% and 5.25%. And I know that that's a large range, right? But you know, if you wanted to tighten it up, 4.5% to 5.25%, people with great credit on an FHA loan should see a rate in the mid to high 4s. Folks who are looking for a conventional loan and, you know, 10% down might see something in the high 4s, low 5s as a rate. But that's where I believe we're headed. I don't think, you know, there's still folks who were saying what happened to the twos. The twos happened because the world shut down.
That was a moment. That is gone. Yeah.
And you know, no one wants to go back there. At least from a day-to-day perspective, no one wants to go back there. Rate wise, yeah, sure, it was great. And no one wants to sell that house. Where am I going to go? I got 200 grand worth of equity in my house that I've owned for 2.5 years.
Yeah.
What should you do? You should grab it and go. Well, what does that mean? I'm going to go pay 5.5% or 6% for a mortgage right now. Some people are struggling with that. What they're not seeing is the big picture. They've achieved the American dream in 2 years, as opposed to what it may have taken our parents or grandparents a generation or two to achieve. Right? Buy your house for 13 grand in the early 60s, and then by the time they left it to their children, it's worth it's a multi-million-dollar property. We're seeing that in the microcosm here, where folks are buying a house for 300 grand in 2020 and able to sell it high 4s, low 5s in 2022. Their issue is, but I have a 3% mortgage. Why would I sell that? Why would I sell that?
At the end of the day, you've got to get a new mortgage. Yeah, definitely.
Just the cost of doing business, you know, and like I said, we keep saying, you know, marry the house and rent the rate. Today's rate is not the rate you're going to live with forever. Right. So if you're willing to forego all that equity and sit tight in the house that you loved, but you might be able to get into a house you really, really love. I think the interest rate is just part of the calculation here. It's like, you know, it's part of the cost, you know, everything comes with a cost, and it's that 2% rate or that 2.5% rate that allowed you to get that equity.
And it's still less than what, you know, in our history, as far as rates go, interest rates. I mean, you know, I'm old, I've been doing this a while, and, you know, I just remember what interest rates were back in the day. And to think that we think that a 5% is high, it's like, and I know everybody's heard that, you know, but so it's been a lot higher. So that still is a great interest rate.
When you economists, and I'm not an economist, but I like quoting economist things because it makes me sound brilliant. Relative to inflation, interest rates are negative. So inflation is running about 8 and change. Mortgage rates are running about, depending on who you talk to, 6 and change. If you subtract inflation from mortgage rates, we're negative, which means it's free money. So we are still in an environment where if you look at it from an inflation perspective, the money to borrow to buy a home is still extremely inexpensive, because you'd like to think that borrowing money should be higher than inflation, but it's not right now. We are below the rate of inflation.
That's a great way to look at it. I haven't heard it explained like that before.
Subtract inflation from your mortgage rate. If it's negative, it's basically free on paper, right? It doesn't translate for folks who are trying to manage a DTI or something like that, or
Yeah.
trying to get into a house and they can't make a payment because it's simply $200 or $300 too much money. Those are folks that, may need to wait a little bit for rates to come down. But everybody I'm talking to, the entire market is certain that they're going to come down at some point. We're not going to hover around here for very long.
Yeah.
We're predicting the next cycle to come sometime in the next, 12 to 18 months is what we're thinking.
Fantastic. Great information. I just want to see if anybody has any questions. I'm looking on here. I don't see any. Do you see any, Dom?
I'm looking at the Q&A. No. And let me just check the chat. Nope. There. I think everybody's good.
Okay. Well, a lot of great information, and thank you again for joining us. And just to let you guys know, we have another, this is kind of our short little series on luxury series, and we're going to have another webinar live on the 28th that we're going to be talking about the luxury inspection. And just know that you can go back on, if you want to watch us again and take notes on, and you missed some information, all of these, as well as some additional webinars that we've done in the past, are on our website under our Home Probe Academy. You can go in there, and we call the Netflix of home inspection. And we just really want to bring as much information to you as we possibly can as it relates to the home inspection process, real estate in general. Our Home Probe Academy, we just, this new on-demand side of it, we were just able to get that all in place. So we're pretty excited about it. So please join us. Again, it's there to be at your leisure. So thank you for joining us, and we look forward to seeing you again. Dominic, thank you for your time today.
Wendy, anytime.
I'll be seeing you around town.
Yes, you will.
Okay. Bye, everybody, and thank you so much.
Bye-bye now. Thanks.
Bye-bye.